So first of all, I'd like to start by introducing some terms here, which are, I think, necessary to understand the software. Nothing really complicated, but feel free to Google these anytime. And there's also a lot of information with these terms on the website itself and in the documentation itself. Just to revisit the documentation again, when you click on the website here, let me show you exactly where the documentation is. And I'm talking about the software documentation. You click on technology, the strategy on the left side, and on the three software boxes here, and user manual. This is here the website address and user manual. There's 14 chapters talking about the software itself, also in text and video format. And if you spend a little time here, you'll get a pretty good idea what we have built here and how you can put it to good use. So this is where the documentation can be found. Not all the pages are open for Google to search. Actually, you need to create a free membership, and to have full access, you need to sign up for the free trial. And another page which is quite useful is the resources page, which is just a little summary of links leading to the most important sections of our website, including the forum, our little community, where a lot of good traders ask a lot of questions over time. And there's a lot of useful information here, not just about our software, but also about Ninja. Click around and feel free to explore the website. Okay, now let's go back to our today's presentation, which is about understanding exactly the algorithm that is the basis of all our three strategies, and also basis of how we see the markets and how we make decisions. And the making decisions involves regardless of the level of automation, we can assign much of the decision-making process to our software if we so wish, or we can retain more of the decision-making process to ourselves if we so wish. Our software doesn't tie us down. We have three versions of the software, but most specifically ProSTR and BT, which offer two different levels of automation options as we trade. And most traders, the more, I think, experienced you become with using our tools, you'll realize that there will be times when you will want to have more automation as you perform a certain trade. For example, the time frame is so fast that you don't want to do the math in your head or make decisions on the fly manually. There's just no time. That's when the software can serve us well. And also, there may be some times, perhaps on smaller or larger time frames, but it depends on the person or the trader actually, where you may want to retain more of the control to yourself, and that's when ProSTR can come handy. We have covered ProSTR and ProSTR BT, the two versions of our software, in many, many other videos before, so I'm not going to detail them any further. Today, we're going to talk about stuff which is true for all of them, but specifically BT, which is the more algorithmic version of the two, the more automated version of the two. Basically, you need to be familiar to some extent anyway to a few mathematical concepts here, one being the standard deviation, then of course ATR, which everybody knows in the trading world, and also linear regression, which is also a quite well-known term. And most importantly, the equation of the edge. If this is not a positive number, then trading makes no sense. This needs to be a positive number for us to be successful on the markets. It is possible, but it's not easy. Otherwise, as they say, everybody would be a billionaire. So it's not so easy, but it's quite possible. And there's really nothing much to it if somebody looks at it the right way. And one way of starting looking at it the right way is by understanding these terms here and understanding the realities of how the crowd behaves on financial markets. We are able to trade a little bit of with this tool because we have identified a certain characteristic of crowd behavior on financial markets. That's the whole story in one sentence. Now, of course, anybody can always ask me, so why are we giving all this away? Why am I sharing all this? Well, simply because I didn't discover anything. As we always say, we stand on the shoulders of giants. There have been people doing the good work before us. If there's anything that we within Remek did, then we put the puzzle together in a unique way, in our own way. And that is something, first of all, we're very proud of. Second, we are the first one to acknowledge all the great traders and commentators and authors of the past that went before, whose work we had to study for years and years to build this tool. So the information that we have used to build this tool and that we're going to discuss today and in any other videos for that matter for the past 10 years is all available publicly. What is unique is how it was all put together. And when I say available publicly, you understand exactly what I mean by that, because the information necessary to build anything else have been available publicly also. How to build a watch, I'm sure it's all out there. You could Google it. Same thing with a car or a piano. Now, that doesn't mean that we have to necessarily build our own watch or car or piano. It would make no sense. It would take 20 years, and probably we would spend a lot of time and money and waste dead-end streets for something that has already been built. So I do urge you to, instead of trying to go down that route and spend 5, 6 years, 10 years that we have done before you can build something else, or just to start with before you can start coding in C# at the level necessary to build something like this, it makes much more sense to just go to the store and buy it and start using it tomorrow morning. So that's the reason why I'm not really giving away any secrets. Actually, I'm promoting the software. I'm showing people how good the software is for this specific purpose. We have mentioned this in some older videos. There's a certain programming technique, even within C#, which we have deployed and kind of discovered or just started to realize. So what you will see from this is that when you put the Remek software on any chart, any time frame, it will be lightning fast. There's no delay. A solid theory is very necessary to build something useful, because we could put together a bunch of indicators, anything from A to Z, and build something like a Lego. And if we try hard enough, sooner or later we'll bump into something that might give us a positive backtest. We put it on YouTube and we start selling the tools. It would collapse as soon as people start putting it on to new incoming data, because there's no theory behind it. There's no actual study of crowd behavior behind it. We have gone the other way around. We have identified a solid theory, and then we started to think about what kind of tools and what kind of mathematics, which includes indicators in our world, are needed to build that tool that is based on that given theory. So this is quite important that you understand it. This is not just a bunch of random indicators put together. There's a lot of things here which went into this software. Some of it is behind the scenes, some of it is right up front. And if you just spend a little time looking at it carefully, then you'll see the value of this. Lightning fast decision process. This is another reason, by the way, while I'm not really shy to tell you all about these and show you all these things, because who amongst us would be able to do all the mathematical calculations on a 5-minute chart or 1-minute chart or even a 50-minute chart based on standard deviation and ATR calculations and volatility changing in real time? Who could do this in our heads? Well, none of us. And we don't have to, luckily, because the computer does it. So all the calculation, what you see, actually, let me just point you to our YouTube channel for just 1 second. Because especially if you're new to this, let me just navigate to one of these videos here. There's one video here which is called BT in action, I think. Where would it be? BT in action. There must be a video here. Algorithmic trading, yes. And there's one here, BT in action. BT at work. So if you just watch this video, regardless of what you trade and how you trade, this video, many others, but this one is the easiest for me to find. This shows the software. What's the end result? See, now we are in a trade with the trailing stop. Gonna wait for another signal. So if you just want to see the end result of all the mathematics, here we go. We got triggered into a trade. First target, trailing stop. First target will get hit, hopefully, soon. And then the trailing will kick in, you see? All these decisions would be impossible to do it at this speed and with this consistency if we had to do this manually. And again, the math is quite sophisticated, but luckily we don't have to worry about it because once you have set up your settings and you save them as a template, the software will execute your instructions to the letter consistently and without fault. And just to drive this point home again, it is always you who decides the settings. The software will not do anything that you don't want it to do. It's you who sets up the trailing stop rules, the entry rules, the quantity, the sizing rules. Everything else is customizable, and you save it in your template. Sometimes I say from Monday to Friday, you don't change the template because from Monday to Friday, you're the trader. Saturday, Sunday, you're the CEO and the researcher. That's when you can look in the data and see if anything needs to be changed. So this is how actually ProSTRBT, as far as I'm concerned, the most advanced tool that has ever been produced for NinjaTrader is we're looking at it right here. Now, we're just running into some winning trades. I'm the first one to say there's always losing trades as well. It's part of running this business. If the mathematics is done correctly, so if we have done our homework, then losing trades simply become part of doing the business, a business cost, something that we don't really have to worry about too much. Of course, we need cushion under our butt, which means capital, enough capital to withstand these losing streaks. You know, even mathematically, there can be 3, 4, 5, 6 loser in a row if we do this long enough. That doesn't necessarily mean it's like flipping a coin. There will be heads and heads and heads in a row. That doesn't mean that it's not a fair coin anymore. But here is just one of the videos where you can see the software in action. Because the theory is solid, and it's based on crowd behavior patterns on financial markets, it follows that it works on any market as long as that market is liquid. We need a crowd for these patterns to emerge, so that we can take advantage of them. And this software was written to specifically identify a certain pattern in the crowd behavior, in the behavior of the crowd on the markets. It can also be used on any time frame. Please note that if you think of a tick chart, you can put on 1,000 tick chart and then 100 tick chart and a 10 tick chart, and then finally a 1 tick chart theoretically. Of course, that would be a crazy fast chart and probably our Ninja might freeze. So any time frame, yes, in theory, but of course there's like a logical or necessary limitation. Since we're not on a couple of feet from the CME mainframes, we are all over the world trading on public internet connections. Obviously, a 1 tick chart or a 10 tick chart is not really our time frame, is it? So be sensible when you choose your time frame. That's my point. Okay, and probably the biggest feature of our software is imagine you can use this software with a certain set of settings on let's say a 5-minute ES chart, and then change the instrument under the chart, but not change the setting, and put on a ZB or a GC or something, a weekly chart. It would be just as logical. All the information that the software would give you would still be valid and true and usable, because all the mathematics behind the calculations are normalized in the background. In other words, you don't have to change the settings if you change the time frame or if you change the instrument. You also don't have to change the setting if the volatility conditions change within one instrument. All right, so just to drive this home again, a couple of major terms here. If your scientifically inclined, or if you're just interested, you can read up on these three concepts. You don't really have to. I mean, you can trade with this successfully. You don't have to become a scientist, but it's kind of interesting, and it helps, I think, to also to start to trust our software once you understand the power that's under the hood. Also, one big feature, this code, because of these, the code will self-adapt. That's what I just mentioned, that if you change the instrument, or if you change the time frame, or if you just trade the same instrument over time, if you just put on any indicator, like just a simple ATR and an ES chart, you'll see that the ATR will not be a flat line. Volatility changes sometimes dramatically. Just look at the situation around the COVID, or even these days, in the past 2, 3 months, there's been crazy moves on the market. Volatility changes dramatically. Sometimes it compresses, volatility compression, sometimes as expansion. And the software, our software, is able to adapt to the changing conditions. One more major point, even a selling feature of this, if you switch on the risk management module, which means that you instruct the software BT to decide if you have enough money on the account to perform a certain trade, yes or no. If you switch it on, and if you set up the settings sensibly, then actually it almost becomes impossible with this software to blow any account. Because if there's not enough money on the account, if the volatility condition changes, the trades would not be allowed. And there will be a message actually in the upper left corner telling you why a certain trigger was not taken, because there's not enough money on the account to do the job safely. This is another, just one of the many useful and unique features of this software. Let me just run through this again. Falsifiability is a scientific term. It means that our entry is quantified, our exit is quantified, which means defined mathematically, and all the trade management rules are quantified, and all this is volatility-based. Now, what this means is that I can run a test and I can find out if our method has merit. And this is crucial. If I'm not able to build something that's falsifiable, that's basically just an opinion, and an opinion cannot be disproven. Okay, so a major feature of our software that it is quantified. You can put it into a test. Actually, if you click on it later, or if you click here later, it will lead to our test on YouTube. Why don't I click right now? And these are all our playlists about backtesting. You can always go back to the numbers and run your own tests to see if you find the same thing that we did, which is that if used sensibly, then this software can lead to success. Okay, now we're getting to the real important stuff. This is how our software was actually built. You see price a little bit in the background, but what you see is basically a linear regression line. It is part of our software. Second, you see a Keltner channel. The way we use it is 5 ATRs. You can see that it contracts and expands, as everybody knows, of course. It's important to understand the whys always. So always give it a little thought. What is actually happening on the chart, and why did we choose this particular tool for a given job? And for example, not the Bollinger Band. With all due respect, of course, to the Bollinger Band, but for our special purposes, what we needed was the Keltner. Okay? So the Keltner channel measures volatility in the way that we prefer in ATRs. You can see, just like everybody knows, that it will expand and contract. That is a measure of volatility. And look at this. The next step in our software is to identify situations when price steps outside of the Keltner. We can color these. And of course, these events, because our methodology is an event-driven methodology. Event-driven methodology, we insist on events happening for some other steps by the software to be taken. And one event, the first important event, is to monitor price and capture the event when price steps outside of the Keltner. In order to capture that, we have to know where the Keltner is. And that is exactly why we use the Keltner. And then, that's not a trade yet, it's just an event that we monitor. Downside, it's magenta, but the same situation, price is outside the Keltner. And then the next step will be when price returns to the middle after it made the excursion to the edge, then it will return. And that is actually the setup for us because this is the consolidation area, otherwise called the pullback channel, long or short, which is a crucial area for us. It's our area of business. This is where we are getting ready to do some business with the market. So as you can see, certain events need to occur before we even consider a trade. Now, just a quick look at this chart will show you that we have signals all over the place. And for example, why do I have a long signal here if this is a bear flag and potentially I'd be more interested in trading short than long? That is because this is the situation, the state of the software before certain filters are applied. And one of the major filters is a trend filter. You'll see that the same situation here, we don't have the long signal already because we have applied the trend filter onto this chart. And now correctly, long and short signals will show up when there's reason to think long or short. You will see another feature, linear regression calculation, that we use to actually measure the strength of the momentum. The wider this cloud, the stronger the momentum. When you see a situation like this, of course, you don't have to make manual decisions because the software will make those decisions for you. But if you want to understand, of course, what the software does and why it does what it does, then this is what this whole meeting is about, this whole workshop is about, to understand how the software makes the decisions. And the way the software makes the decisions is that it measures the strength of the momentum, understands that we have a strong momentum behind our back. We have a indication of a short signal, which means all the preconditions to go short have become true. Plus we have the momentum, which means that taking these short trades. So this means that this is a safe area to go short from. Okay, so there are various filters in the software that help our work, namely, again, the trend filter, the signal counter, and the chop filter. You will see that in these areas, for example, there is no signal. This last one could have slipped through, but here in this area, there's no signal. And that's not an accident. That's because our chop filter filters them out, saves us from a lot of potentially suboptimal entry points. For example, here you see the same chart. If I see it correctly, here we have two long signals. These long signals have been filtered out. And there's a couple of other filters that we can talk about, the buffer zone, namely, and the exhaustion filter. The exhaustion filter, I can show it to you on this chart, actually. The exhaustion filter is a very simple rule. None of these rules are complicated. Of course, the main selling point is that this has been all automated. You don't have to make these decisions as you trade. It takes the burden off your shoulder. You can focus on what actually a trader as a human being should be focusing on, and not these mathematical calculations which we hand over to the computer and the software to do. All right, so here in this situation, this is what we call a climax or an exhaustion. Yes, price did step outside of the Keltner. Yes, potentially we are interested in further shorts, but hey, who wants to go short after an exhaustion? An exhaustion means that probably the last guy who wanted to sell has already sold. We don't want to go short after that guy. The situation is shown to us by our smart charts and by smart calculations, which means that our software will never tell you to take a short after an exhaustion if you have the exhaustion filter switched on. This is just another filter that saves us from many suboptimal trades. Okay, and then there was the buffer zone. A buffer zone is in one way, is the opposite of the exhaustion filter. Means, so the exhaustion filter, if you think of it this way, it's like too much of a good thing. You see, we do want price to go down. Yes, we are short. The lower it goes, the better for us. But this is just too much of a good thing. It went too far too fast. Going short after exhaustion, you can test it out. It's usually not a good idea. Let's just assume for a second that we are using this area to go short from. This is a typical bear flag. It's part of our job, nothing new. This is what we have trained ourselves to do, and this is what we build the software to do for us. And this is a reasonable area, business area for us to go short from. All good. And let's say that here's a signal. This is the signal that I'm talking about. Here's the signal, and then I go short, and I'm short. And suddenly, what happens next? Let me use a different color. Price does this. And it will happen. It will happen. About maybe 25, 30% of trades, all the trades that we ever do, yeah, about a third or a fourth or a quarter will fail. Nothing we can do about it, except to manage our risk, of course. Now, buffer zone. Okay, so buffer zone means that if I'm in a trade or if I got a signal into a certain direction and then price suddenly revisits the opposite counter, that's a red light for us. That means that further shorts are going to be filtered out. If this event should ever happen, there will be no shorts after that. Goes the same way to any long trades. Like if you want to go long and suddenly price comes down here, then that means that the game has changed and we don't want to take long trades. Now, the cool part about these filters, all of these, the buffer zone and the exhaustion zone, is that they switch themselves on automatically, and they're not going to be switched on forever. They are able to follow events and they will switch themselves off automatically. Once you switch on the buffer zone filter, for example, switching on and switching off, these two events will happen automatically. You don't have to worry about it. If conditions change and if you start to get bull flags and the market goes up, then rest assured you will not miss the long signals. The same way with the exhaustion zone. So just because we had an exhaustion, it doesn't mean that it's going to be switched on for 100 years. Of course not. And you don't have to worry about switching it off because it will switch itself off automatically. This is all mathematically defined in the software. It's all coded. All you have to do is just go to the user interface, click on the given boxes, decide about the settings, and then click OK, and you're done. And now, enough of this slideshow. I want to really spend some time in NinjaTrader. First of all, if you're a new user, let me just start by saying that in the corner here, we have what we call a Market Scanner Pro. These columns are, the first two come from NinjaTrader, of course, but all the others is our own creation. And these numeric values here, which could be like Greek to you right now, but believe me, these are easy to understand mathematical calculations and also visually presented in a very friendly way, just by a quick look, can help you understand what is happening on any number of charts, any number of markets that you choose to put on this list. And there are videos about this. I'm not going to go through all the columns. We've covered this 100 times before. Look them up. Fascinating stuff. And it can give you information just by a quick look. So check this out. This is a long setup, right? Where is the long setup? Here. Now, this is not a trigger yet. Don't get confused. This is not a trade yet. The trigger will show up in the signal column. So right now, there are no signals on any of our 4-hour charts. This could change, of course, anytime. If you want to see the setups and the signal on a chart, on a time frame other than the 4-hour, no trouble at all. This is what I wanted to show you. Let's say you don't want this to be calculated on a 4-hour chart. You want this to be calculated, I don't know, give me a time frame. Maybe you want the setup on a 5-minute chart. You're a 5-minute chart trader. That's perfectly fine. All you have to do is to scroll down here and change this 240, which is 4 hours, to 5. From this moment on, if I click apply, this will recalculate itself and give you all the setups on a 5-minute time frame. And if you want also the signals on a 5-minute time frame, because it kind of makes sense. Now, if I use the setup on a 5-minute time frame, then what's the point of getting the signal on a 4-hour chart? Of course, then I want to also change the signal to the same time frame. There's no signal without a setup. A setup must come first. So all these situations, long and short setups on the 5-minute chart, they tell you what is happening before things happen. And not every setup will transition into a signal. That's important to know. But when they do, what happens is now that signal is also being calculated on a 5-minute chart. Every 5 minutes, when the candle is closed, this information will update itself. You can see that now we have 2 signals actually on a 5-minute time frame. And I don't have to open up the silver market or the British pound to know this information. And what happens is that when you have a short setup on a given market, and then if it becomes a trigger, a signal, then there will be a short trigger appearing here. And at that moment, the setup disappears. So that's how they transition. One transitions into the other. Now, of course, the trade will not be taken unless you have a strategy running on that chart. All right, and all the other columns are useful here one way or the other. I'd like to just emphasize again the importance of the last column. In my practice of 15, 20 years on this market, one of the major reasons for traders not being successful, and I'm sorry if I'm a little harsh here, is not recognizing the importance of this column, not recognizing the actual risk that must be carried when we enter a trade. Remek converter calculates the actual risk that we have to deal with when we enter a trade on a given market at a given time on a given time frame. And look at this, the NQ is by far $10,590 for one ATR on a daily time frame. And most people, most traders, somewhat naively, actually extremely naively, just look at the tick size. One tick is $5. So NQ is less risky than the ES, which is $12.50. It's exactly the other way around, actually. Look at this, 10,600, and the ES right now is 6,000. So the NQ, trading the NQ is twice as risky as the ES, although the tick size on the ES is more than double of what it is on the NQ. Does it make sense to you guys? This is crucial. And we have specifically built an indicator that does the elaborate mathematical calculation to give you the actual reality risk level of trading an instrument. Okay, by the way, the mathematics of the Remek converter indicator, which is in this column, is also inside BT. As you know, the indicator, the only difference between an indicator and the strategy is that the indicator puts information on the chart and calculates mathematical calculations, of course, but it will not enter into a trade. A strategy does everything the indicator does, plus can also enter and exit and manage trades. Why don't I put the strategy on the chart and BT on the chart? Because that's where stuff happens. BT. So let's just put BT on the chart. I'm going to enable it. And now you will see the blue button here, and now BT is active on the chart. Since we have the strategy on the chart, I'm actually free to remove the indicator. I don't need two of them. Here we go. So now I have the strategy on the chart. Of course, it's a daily time frame, so I'm not going to get a signal every 5 minutes, obviously. But if I change it to a 5-minute chart or any tick chart or anything else, then it would do the calculations on a smaller time frame. You can see that these are the signals, long signals, and we have some short signals as well. Okay, so we talked about the actual algorithmic signal, how it is generated. Let me just repeat this one more time. So here we go. So there's a trend. There is a Keltner channel. And then there will be situations where price, I'm not very good at drawing, but when price touches or penetrates the Keltner channel, let's say penetrates like here, that will be called a breakout candle. That's an important event for us. Then price pulls back, and then we're going to deal with some kind of setup. And if it triggers, then we get a trigger. Now, this is all calculated automatically. What I want to show you now is, for example, that we don't want to trade against the trend. So we need a trend filter. Now, one very important concept, as it's a software design concept that I want you to understand and embrace, that we as a software company, as the designers of this software, we don't want to tie down people's hands. We don't want to limit your options. It's like, imagine you buy a car and the windshield wiper only goes at a certain speed. But what kind of windshield wiper is that? What if the rain changes? Well, I can't make it faster, I can't make it slower. It wouldn't make sense. Of course, the user can adjust the settings to the current situation or to the current needs. Same thing with the gas pedal. Wouldn't be useless if the car just only could go with one given speed. Same thing with the software. We do not want to limit choices, and we provide guidance, like in the user manual, as to how to think as we go about making selections. Like if it rains more, then I switch it up faster, stuff like that. Same thing with the software. And then once you made the choices, you can save the template. And then once a week, you review the settings. And if you want, you can change the settings. But I wouldn't say you have to change it too often because it's self-adaptive. So 80% of the settings will adapt themselves automatically to the changing situation. Now, there are a few which would be manual choices. And one of them I want to highlight here. I want to say a few words about the trend filter. If you click here, you will see that we have 4 choices. None of them is necessarily better or worse. Actually, all these trend filters are professional trend filters, valid concepts. And the difference, whichever you use, you can trade successfully with any of them. Still, there may be some preferences, and which is explained in the documentation. So I'm not going to spend too much time going into the details of what is the difference between them. But the point is that you do have a choice. And if you choose the composite, which is one of my favorites, actually is my own design. The whole concept is my own design. This is a proprietary definition of the trend. You're most welcome to use this, or you can use our version of the ADX VMA, which is what you will see on many of our charts in our videos, because this is my default setting, and I've been just happy with it for years and years. So there's no reason for me to fiddle with these settings anymore. But again, the concept is that if you review these settings, many times you have a choice in the documentation. You can look up which is which, what's the difference, make a decision, run a couple of tests, decide what you like, save the template, and then focus on the job. Stop fiddling with the settings for years and years, because the settings are just fine. Success lies elsewhere. Another concept that I want to just mention quickly is many of the other slow triggers, fast trigger. These are the actually the linear regression calculations. For example, the 10-3 indicator, no secret, comes from a book from 1997, and the concept has been described and used in many other books since. And linear regression is a valid mathematical concept. Using it in trading is completely justified, and we are using it too. Now, what is the point I'm making? The point I'm making is that you see, although this is a famous concept, the 10-3 is a famous proportion which tests out positively in our tests. But having said that, we would not be professional software designers if I forced you to use 10-3. Of course, I'm not going to do that. If you want to come up with your own linear regression calculation and say you'd rather use 12-5, you see, we are a software company. Of course, you can if you want to. You save the settings and you're using your own settings. Okay? So you do want to review the settings. You do want to, I firmly believe trading success cannot come from copying somebody. You must make this your own. This is like buying a house. You bought the house, good, but you have to make it your own. So consider these settings, go through them, deepen your knowledge about the concept, never stop learning. One cool thing about trading, it's lifelong fun if you do it well because it never ends. It's like studying the piano. You can always become a little better, however good you are. Same thing with trading, it never stops. And having said all that, I'm not going to ramble on, but if I go back to the linear regression line, then of course the default setting is 10-3. And if you just want to leave it 10-3, that's perfectly fine. You will find that the tests are positive. But if you want to design your own custom made version of your magic soup, your gumbo, then this is a software. You can do it. Same thing with the 80-20, valid concept. Same thing with any of the other settings here. Now, what these settings mean, we try to be a professional software company, so all these settings are explained in the documentation. You can go to the last pages. Every setting is explained. I hopefully in such a way that you can understand it, but if you ever have a question, you see, these are colors. So colors is no specific explanation is required because these are colors. But there's some other settings where there's actually a text. Look at this. Give me a second. I'll show you the other page where setting explained, you see, BT setting explained. There is a textual explanation. Look at this, sometimes longer, sometimes one sentence, sometimes 50, as much as it's necessary. It's all here. All right. So feel free to dive in deep. Look, this is a race. This is a competition. You have to understand, any of us, if we venture out onto the financial markets, we have to understand who are our opponents, especially on the futures markets. Our opponents are some of the best of the best. We can't show up with a club, so we have to be ready for the battle. It is a battle. People are out there. Their job is to take our money. We have to know what to do. We have to be prepared. And those people, they did their homework. So we have to do our homework as well. So while this is a powerful automated tool, it is important to understand how the machine works so you can train it and you can customize it to your own needs. And I think it's also fun. This is kind of fun to think about the solutions and think about the acceleration ratio and the maximum acceleration. And this is all mathematics. This is all considerations you need to go through at least once or regularly, twice a year maybe, and think about it and run the test to make sure that they're sensible and they bring the results that you want. One more thing I definitely want to show you is the risk management module, because that's probably another very powerful area of the software. So if you scroll down, just to sum things up, About maybe 30%, 40% of the options are colors. And colors is just a personal choice. It's up to you. You can make it pink, any color you want. But you see, colors, they do not play into the mathematical calculations, of course. So whether you choose this blue or green, the math will be the same. The trigger signal, everything in the software will be obviously the same. That goes without saying. Also, another important concept, and for you to know and remember at all times, please, is the display options. Let me show it to you. The display options, this area here. The display options defines what you will actually see on the chart. You want to see the Keltner? You want to see this? You want to see that? This is where you choose them. If you don't want to see them, if you don't want to see the Keltner, you don't have to look at the Keltner all day. We just use it in the mathematical calculation. Of course, personally, I think it looks beautiful, so I would put it on. It helps me. But the point is that you're the one who chooses what you want to see on the chart. And here's the point that I'd like to make now. The display options, what's on the chart, what you choose to display on the chart is independent of what goes into the mathematics. I think it's obvious, but let me just say this again. So if you choose to display the midband, which is the SMA 20, let's say by default, if you choose to display it, or if you choose to hide it, the Keltner channel would still be calculated, the volatility would still be calculated, all the mathematics would still be calculated. If I don't want to see the breakout bars, maybe I don't want to see them. Maybe I want to keep my charts as clean as possible. That's fine. But the software would continue to monitor, of course, events, price action events on the market, because this is how we make a decision. So the display options do not influence what goes into the mathematics. You can display or not display certain parts, certain visual elements of the chart. And so that's one thing I wanted to emphasize. And the other one is that there are some other calculations which do play a role, which do influence the mathematics. And those, they're kind of obvious because the chop filter sensitivity, I usually use it 1/3 of an ATR, which is 33%. But if you want to choose 50% of the ATR, put it to 0.5 is 50%. That's all cool. But then that kind of sensitivity is what will go into the mathematical equation. Okay? So these settings, these numeric settings, will influence and define the mathematical calculations that at all times goes on in the background. Also, the ADX-VMA and the linear regressions, all these numeric values, you see the width of the Keltner, it doesn't have to be the default setting. Even the EMA, you can change it to an SMA if you want. These will all influence the calculations of the software behind the scenes. Okay? Now, to make life easier, when you install the software, it comes like any software, it comes with factory settings. So certain settings will load when you first time you load the charts, and these settings, they are my favorite settings. That's what I want to say. They are my favorite settings, the ones that I'm using. I experimented enough before that, and I'm okay with my settings now. That doesn't mean that I might not change something in the future, but what I'm saying here is that that's a pretty good start. When you first start with the software, start with the default settings, and then gradually you can learn more and more about these settings. It's very, very simple. So it's not rocket science. So not for 1 second do think that this is difficult. It's not difficult. Just need a good coffee, sit on a porch, and read the documentation and think about it. But last point, before I forget, I wanted to show you the risk management module. Auto, which means in which case the calculation is done automatically in US dollars. And this is how it works. Let's say you have a $100,000 account, just to use a round number, and you want to say that at any one time, the maximum I will risk is, let's say, 2% of my account size. Then what you're going to do is risk per trade, and 2% of 100,000 is $2,000. So if you set this to 2, then that will mean $2,000. Actually, it will mean 2% of whatever you have. Okay? You can also set the daily gain or loss. Let's say you made 1%, you made $1,000 profit, you made $1,000 loss, you want to stop trading automatically. You can, of course, stop trading manually anytime you want, but we're talking about algorithmic trading. Now, what's the beauty of this is that, let's say your maximum risk is 2%, $2,000. And let's say you made a couple of trades and now your account size is $110,000. This will automatically adjust to 2% because now the 2% is not $2,000, it's $2,200. So you get the picture. Also going down, if let's say your account size is suddenly $90,000, then the 2% now is $1,800 instead of $2,000. So it will automatically adjust. And before each trade, this calculation is done automatically. You don't have to think about it. So if I set this to, let's say, 1% or 2%, whatever the value you choose, if your account size should, for any reason, go below a certain limit, then the trade would not be allowed. Now, how does the software decide what is allowed and what is not allowed? It decides based on the stop you set. We don't measure risk in US dollars. We have to measure risk in volatility. So we choose our stop. We define our stops in ATRs. 2.5, remember, is exactly the distance between the SMA 20 and the Keltner channel the way we use it. But if you set it to 3, it would be very close to the opposite Keltner. That's a good initial stop. Of course, we can later adjust it and start to trail. And it doesn't mean that we have to stay there forever at 380. Of course, we can tighten the stop. The software will do it for us if we set up after how many bars, how close we want to be. All these settings are explained in detail in the documentation. Very simple. And you can just think about it once. Once you save the template, every trade will be done exactly the same way. Going back to the risk for 1 second, if I set this, let's say, for any reason, I want to start trading. You see, one contract is 3 ATRs. Let's say I want to put on 2 contracts. Now, 2 contracts, 3 ATRs each. That's 6 ATR risk altogether. If I choose 3 contracts, that's 9 ATR risk altogether. Let's say I go along here. My entry point and the Keltner below me, this distance, has a dollar value. And the software calculates the dollar value. Let's say it's $800. It's the same calculation that Remek converter does, by the way. If you multiply that 9 times, depending on your contract size, the software may find that this $2,700 or whatever that is bigger than the 2% that you allowed, which means that your risk management rules, your maximum risk, would be violated if you took this trade. So the software will not allow the trade to be taken, and it will put a message in the upper left corner and tell you the reason why. We have videos about this, so you go to YouTube and watch these messages appearing in real time. There's always a message. You always know at any point in time why the software did what it did. And of course, certain things you can do. You can put money on the account. Of course, you can put $1 million on the account and probably this red message would disappear, obviously. Or you can decrease the contract size to 1. That might do it as well. Long story short, the software protects you. And if you set this up sensibly, then it becomes actually it does become impossible to grind the account to 0 because the trades would not be taken. Okay, so I'll stop right here. I think I managed to sum it up. There's many other little details, but there's various videos about this. And in this workshop, I just wanted to drive home the main message that this is lots of power under our belt. And let me ask you if you have any questions. Thank you very much, everybody, for joining me today. Let us know if there's any questions you may have in the coming days. And follow us on YouTube and Premium to keep pace with the markets. A lot of things are happening. We're not going to go into that in this workshop, but immensely important things are happening on the market as we speak. So join Premium to be on top of all those. Thank you again. All right. And I'll talk to you soon.